Type, "What's a good PE ratio?" into Google, and you'll get the same answer from almost everyone. It depends. Technically true. Completely useless when you're staring at a stock right now, trying to decide if it's expensive. So let's do the thing the internet keeps dodging. Give you a real answer, then show you why the honest version is more useful than the number you came for. Start with what the ratio actually measures. PE stands for price to earnings. You take a company's share price and divide it by its earnings per share, the company's yearly profit sliced across every share. Say a stock trades at $20, and over the past year it earned $2 per share. 20 divided by 2 is 10. That's a PE of 10. Here's the way to feel it. You're paying $10 for every single dollar of yearly profit the company makes. A PE of 10 is 10 years of today's earnings to cover your purchase price. A PE of 40 is 40 years. The higher the PE, the more you're paying for each dollar of earnings. So is there a good number? There's an anchor, and the people saying it depends usually slip it in anyway. Across the broad U.S. market, the long-run average PE sits somewhere in the high teens to mid-20s. So a stock trading around 20 times earnings is roughly in line with the market. Well below that, it's cheap against the average. Well above, it's expensive against the average. But that anchor is a starting line, not a verdict. And here's where "it depends" actually earns its keep. Because a PE isn't really a price tag. It's a bet. A high PE means the market is paying up, not for the earnings the company makes today, but for the earnings it expects tomorrow. Investors will pay 40 times current profits because they think those profits are about to grow fast enough to make 40 look cheap in hindsight. A low PE is the opposite bet. The market is paying little for each dollar of earnings because it doesn't expect much growth, or it's worried earnings are about to shrink. So a high PE can be a bargain if the growth actually shows up. And a low PE can be a trap if the earnings quietly fall apart. The number alone won't tell you which. The number tells you what the market expects. Whether that expectation is right, that's the actual question. Which is exactly why one PE in isolation is close to meaningless, and why everyone tells you to compare. Compare it to the company's own history. Is it pricier than it usually trades? Compare it to its industry. A bank and a software company live in completely different PE worlds, and judging one by the other's standard tells you nothing. And compare it to the broader market, that 20-ish anchor. A PE only becomes information once it's sitting next to something. The ratio has blind spots too. If a company loses money, there are no earnings to divide by, so the PE comes out negative or just blank, useless, not necessarily bad. Plenty of young, fast-growing companies have no meaningful PE for exactly that reason. And the E itself can be nudged. Buying back shares shrinks the share count and lifts earnings per share, which quietly pulls the ratio down without the business actually getting better. The PE is only ever as honest as the earnings underneath it. One last wrinkle. The PE you usually see looks backward. It uses the last 12 months of real reported earnings. That's the trailing PE, accurate, but already in the rear view. The other version, forward PE, uses analysts' estimates for next year's earnings. It's more useful if those estimates are right, and just a guess if they're wrong. A stock that looks expensive on trailing earnings can look perfectly reasonable on forward earnings, precisely because the whole bet is that earnings are about to climb. So, what's a good PE ratio? The market's low 20s is the honest anchor. But the better answer is the one the "it depends" crowd never quite says out loud. A PE isn't a grade the market hands a stock. It's the size of the bet the market is making on that stock's future. A good PE is just one where the growth shows up to justify it. Nail that part, and the number takes care of itself. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.